Fear is the oldest and strongest emotion of mankind. It is a ghost in our machine, a survival instinct honed over 100,000 years on the savannah, designed to protect us from the rustle in the grass, the shadow in the cave. It screams at us to run from danger, to fight for our lives, to seek the safety of the herd. This ancient wiring, this primal code, is what kept our ancestors alive. But in the modern world, in the digital savannah of the stock market, this same instinct becomes a weapon turned against us. It is the very thing that ensures the majority will fail, that they will transfer their wealth to the select few who have learned to master it. When the screens turn red, when the headlines scream of crisis, when the herd is stampeding for the exits, your heart pounds, your palms sweat. The ghost in your machine screams, "Sell, run, save yourself," and most people obey. They sell at the bottom, locking in devastating losses, convinced they have narrowly escaped a worse fate. And then, when the skies are clear, when the headlines are euphoric, and the herd is giddy with greed, another instinct takes over. The fear of missing out. They buy back in at the top, just in time for the cycle to repeat. This is the great and tragic rhythm of the market, a cycle of wealth destruction powered by our deepest, most ingrained instincts. But what if you could change the wiring? What if you could transform that primal fear from a liability into your single greatest asset? What if you could look at a market crash not with terror, but with the cool, calculated excitement of a hunter? This is not a fantasy. It is the core philosophy of the most successful investor in human history. Warren Buffett has built an empire of hundreds of billions of dollars, not by predicting the rain, but by bringing an ark. He has made his most legendary investments, the ones that have minted fortunes, during times of maximum pessimism, during what he famously calls the sale of a lifetime. His secret is not a complex algorithm or a hidden piece of information. It is a simple story. A mental model so powerful, it can completely rewire your brain's response to financial chaos. It is the story of a strange, emotionally unstable business partner named Mr. Market. This parable, taught to him by his mentor, the father of value investing, Benjamin Graham, is the ultimate antidote to the fight-or-flight response that governs the financial lives of 99% of people. It is the master key that unlocks the ability to be greedy when others are fearful, and fearful when others are greedy. Today, we will not just tell you this story. We will deconstruct it, weaponize it, and install it as a new operating system for your financial mind. We will explore the 5 pillars of this mental model, the psychological principles that give it power, and the practical blueprints to apply it to your own journey towards wealth building and financial freedom. This is not just another video about investing. This is a masterclass in emotional alchemy. This is the final promise, that by the end of our time together, you will never look at a market crash the same way again. You will learn to silence the ghost in the machine and hear instead the quiet whisper of opportunity. The story of Mr. Market is not just an idea, it is a lifeline, forged in the fires of the greatest financial cataclysm of the 20th century. To truly understand its power, we must travel back in time, not to the gleaming headquarters of Berkshire Hathaway in Omaha, but to the dust and despair of the 1930s. Our protagonist is not yet Warren Buffett, but his intellectual father, Benjamin Graham. Graham was a brilliant man, a star student at Columbia University, a prodigy who started his own investment partnership on Wall Street. By the mid-1920s, he was a resounding success, a self-made millionaire living a life of comfort and intellectual rigor. He was playing the game and winning. But then, the game changed. The crash of 1929 was not just a market correction, it was a societal reset button. It wiped out fortunes, shattered lives, and plunged the world into the Great Depression. Graham, like so many others, was devastated. He lost nearly everything. But for a mind like Graham's, this catastrophic loss was not just a tragedy. It was a data point. It was the ultimate, brutal lesson in the market's capacity for irrationality. He saw firsthand how the mood of the crowd could swing from giddy optimism, where any stock was worth any price, to suicidal despair, where sound, profitable businesses were priced for bankruptcy. He realized that the greatest danger to an investor was not a bad business, but the emotional vortex of the market itself. He spent the next decade wrestling with this problem. How could one invest safely, intelligently, in a world governed by such wild swings of emotion? The answer, he concluded, was not to try and predict the mood swings, but to insulate oneself from them entirely. He needed a way to frame the market not as an all-knowing God whose judgment must be obeyed, but as something lesser, something flawed, something you could deal with on your own terms. And so, in his 1949 masterpiece, The Intelligent Investor, he created one of the most enduring allegories in the history of finance. In Chapter 8, he introduced the world to Mr. Market. He asked his readers to imagine they were partners in a private business with a man named Mr. Market. This partner was the soul of accommodation. Every single day, without fail, he would show up and tell you what he thinks your interest in the business is worth. And not only that, he offers to either buy you out at that price or sell you his interest at that same price. But Mr. Market has a problem. He is, to put it mildly, emotionally unstable. He is a manic depressive. Some days, he arrives in a state of incredible euphoria. He sees nothing but a golden future for the business. On these days, he quotes a ridiculously high price. The prospects of the business might not have changed at all from the day before, but his mood has, so his price has skyrocketed. On other days, he is inconsolably pessimistic. Everything is going wrong, the world is ending, and the business is doomed. On these days, he quotes a desperately low price, offering to sell you his share for a fraction of what he was demanding just weeks earlier. Graham's genius was in the punchline. He wrote that the intelligent investor is free to completely ignore him. You are under no obligation to transact with him. If you don't like his price, you can simply close the door and wait for him to come back tomorrow with a new one. You should not be influenced by his mood swings. You should form your own opinion of the business's value, based on facts and analysis. You transact with him only when it serves your interest. You happily sell to him when his manic optimism leads him to offer a foolishly high price, and you eagerly buy from him when his depressive pessimism leads him to offer a foolishly low one. The rest of the time you do nothing. You simply let his manic chatter fade into the background. Now, fast forward a couple of years. A young man in Nebraska, a voracious reader obsessed with business and numbers, picks up a copy of The Intelligent Investor. His name is Warren Buffett. He reads the book, and as he would later say, it was like finding an instruction manual for his own brain. But it was Chapter 8, The Parable of Mr. Market, that struck him like a bolt of lightning. For Buffett, this was not just a clever metaphor. It was the fundamental organizing principle for an entire investment philosophy. It was the key that unlocked everything. He understood at a cellular level that the market was not a barometer of value, but a barometer of sentiment. And sentiment was a tool to be used, not a force to be succumbed to. He had found his Bible. The reason the Mr. Market allegory had such a profound impact on Buffett, and why it remains so powerful today, is because it provides a direct psychological countermeasure to a deeply embedded flaw in human cognition. The principle at work here is a concept from behavioral finance known as anthropomorphism. This is our tendency to attribute human traits, emotions, and intentions to non-human entities. We do it all the time. We get angry at our computer when it freezes. We talk to our cars. We see faces in the clouds. It's a mental shortcut that helps us make sense of a complex world. Benjamin Graham's genius was to intentionally leverage this bias for a productive purpose. The stock market for most people is an abstract, terrifying, and all-powerful force. It's the Dow Jones Industrial Average, the S&P 500, an impersonal stream of numbers and flashing lights. When this abstract force turns against you, when the ticker is a sea of red, It feels like you are fighting an omniscient god, a tidal wave of global opinion that is telling you that you are wrong. Your decision to buy that stock, your belief in that company, is being invalidated in real time by this massive, impersonal entity. This triggers a profound sense of anxiety and doubt. Who are you to argue with? The market. By personifying this abstract force into Mr. Market, a single, flawed, emotionally volatile individual, Graham performs a brilliant psychological jujitsu. The market is no longer a god, it's just a guy. And he's not a particularly smart or stable guy at that. He's your business partner, and frankly, he's a bit of a mess. This act of anthropomorphism externalizes the market's irrationality. It is no longer a reflection of your own flawed judgment. It is a reflection of his flawed personality. When the market crashes, it's not the world telling you you're an idiot. It's just Mr. Market having one of his depressive episodes again. This simple reframing creates a critical emotional distance. It moves the locus of control from the external market to your internal decision-making process. You are no longer a passive victim of the market's whims. You are an active participant who can choose whether or not to engage with your erratic partner. This is a crucial defense against what psychologists call emotional contagion, the tendency to feel and express emotions similar to and influenced by those of others. In a market crash, fear is contagious. When you see others panicking, your mirror neurons fire, and you begin to feel that same panic. The Mr. Market allegory acts as a psychological vaccine against this contagion. You see the panic not as a valid signal of danger, but as a symptom of your partner's illness. You can feel sympathy for him, perhaps, but you have no desire to catch his disease. So how do we take this powerful psychological principle and turn it into a concrete, actionable tool? This is the blueprint, the applied mental model that you can begin using today to build your own fortress of emotional calm. We call it the Meet Mr. Market exercise. It's a three-step process of visualization and habit formation. Step 1 is to create your character. I want you to literally close your eyes and construct your personal Mr. Market. Don't just think of him as a vague concept. Give him a face, a name, a personality. Is he a fast-talking, sweaty salesman in a cheap suit? Is he a nervous, perpetually worried academic who jumps at every shadow? Does he wear a top hat on his manic days and a rain cloud over his head on his depressive ones? The more vivid and detailed you can make him in your mind, the more real and effective the allegory will become. Give him a name. Maybe it's not Mr. Market. Maybe it's Anxious Al or Manic Mike. Personalize it. This character is your new, unwanted business partner. Step 2 is to script his dialogue. What does this character say to you on different types of days? On a day when the market is up 3%, imagine him bursting through your door, face flushed with excitement. "We're geniuses," he shouts. "This thing is going to the moon. I'll buy your shares right now for double what they were worth last year. We have to buy more. Mortgage the house. We're going to be rich." You need to hear his voice, feel his manic energy. Now imagine a day when the market is down 5%. He shuffles in, pale and trembling. "It's over," he whispers. "We're ruined. The whole system is collapsing. I knew this was a mistake. I'll sell you my shares for anything you can offer, pennies on the dollar. Just get me out. We have to sell everything before it goes to zero." By scripting these interactions, you are preloading your brain with the proper framing. You are rehearsing the act of seeing market volatility not as data, but as the ramblings of an unstable individual. Step 3 is the daily check-in. This is where you turn the model into a habit. For the next 30 days, whenever you check your portfolio or look at the financial news, your first action is to consciously invoke your character. Before you even process the numbers, ask yourself, what is Mr. Market's mood today? What is he offering me? If the market is up, visualize him in his euphoric state and practice saying, "No thanks, Mike. Your price is ridiculous today. I'm not interested." If the market is down, visualize him in his despair and practice saying, "Interesting offer, Al. I know the business is fine, so your panic might be an opportunity for me. Let me think about it. The goal of this exercise is to create a cognitive buffer. It inserts a moment of conscious thought between the market stimulus and your emotional response. Over time, this buffer becomes automatic. The news of a market plunge will no longer trigger an immediate fear response. Instead, it will trigger the mental image of your pathetic, panicked business partner, and your first thought will be, "I wonder what bargain he's offering me today." This is how you move from being a reactor to an actor, from being a pawn of market emotion to a master of your own financial destiny. To truly appreciate the wisdom of this path, we must shine a harsh light on its opposite, the path of the 99%. This is the path of those who have never met Mr. Market, or if they have, they've made the fatal mistake of taking him seriously. The antithesis of the Mr. Market model is what we can call the market as oracle fallacy. For the vast majority of participants, the stock market is not a moody business partner. It is a divine, all-knowing entity. The daily fluctuations of the Dow or the Nasdaq are not seen as the chaotic noise of crowd sentiment, but as a real-time report card on their intelligence and their decisions. A green day, where their stocks are up, provides a dopamine hit of validation. I was right, they think. I'm good at this. A red day, where their stocks are down, is a judgment. I was wrong. I'm a fool. I've made a terrible mistake. This mindset chains their self-worth directly to the random, short-term movements of the market. They are perpetually seeking the market's approval, like a child seeking the approval of a stern parent. This leads to a cascade of disastrous behaviors. Because they see the market as an oracle, they become obsessed with trying to decipher its cryptic pronouncements. They fall prey to the cottage industry of market timing. They watch financial news channels where pundits confidently predict the market's next move, treating these guesses as gospel. They subscribe to newsletters that claim to have cracked the code. They stare at complex charts covered in squiggly lines, head and shoulders patterns, Fibonacci retracements, moving average crossovers, believing that these patterns hold the secret to the future. They are, in essence, trying to predict the mood swings of a madman. They believe that if they can just figure out what Mr. Market will do tomorrow, they can get rich. This is a fool's errand, and it's a costly one. It leads to constant trading, racking up fees and taxes that eat away at returns. It creates a state of perpetual anxiety, as they are always one bad prediction away from ruin. But the ultimate failure of the market as oracle mindset comes during the inevitable market crash. When the oracle speaks not in whispers, but in a thundering roar of negativity, the believer has no defense. If the all-knowing market is plummeting, it must know something they don't. The message is clear: get out now. They are swept up in the herd, selling in a panic, because to do otherwise would be to defy their God. They have no independent basis for valuing their investments. The only value they know is the price the market tells them, and that price is in free fall. They sell at the point of maximum pessimism, crystallizing their losses. This is the path of the 99%, a painful journey of emotional whiplash, high costs, and catastrophic mistakes at the worst possible times. They are not partners with Mr. Market. They are his slaves, forever dancing to the tune of his manic depressive symphony. The difference between these two mindsets isn't just philosophical. It translates into a massive, quantifiable financial advantage. The direct financial connection of the Mr. Market allegory is rooted in one of the most fundamental concepts in all of value investing: the critical distinction between price and value. Price is what you pay, value is what you get. For most people, these two things are one and the same. The price of a stock times its value. But the intelligent investor, armed with the Mr. Market mental model, knows this is a catastrophic misunderstanding. Price is simply what Mr. Market is quoting today, based on his mood. It is temporary, emotional, and often irrational. Value, on the other hand, is a measure of the underlying business's intrinsic worth, its assets, its earnings power, its future prospects. Value is durable. based on business reality and changes slowly. The entire game of value investing, the source of all of Buffett's wealth, is to exploit the temporary gaps that Mr. Market creates between price and value. Let's quantify this. Imagine a great company, a leader in its industry, with a strong brand and consistent profits. You do your homework. You study its balance sheet, its income statement, and you calculate that the intrinsic value of one share of this business is approximately $100. Today, however, the broad market is in a euphoric mood. Mr. Market is giddy, and he's offering to sell you shares at $150. The investor who believes the market is an oracle sees this rising price as a sign of a great investment and buys in. The investor who sees Mr. Market as an erratic partner simply says, "No thank you, your price is disconnected from reality." Now imagine 6 months later, a recession hits. Fear grips the market. Mr. Market is in a deep depression. He is convinced the company is doomed. The underlying business is still sound. It's still worth about $100 a share, but Mr. Market is now offering to sell those same shares for $50. The oracle follower who bought at $150 is now in a state of terror, down 66%, and likely to sell to cut his losses. But the intelligent investor sees this for what it is, a golden opportunity. He is being offered the chance to buy a $100 asset for $50. He eagerly accepts Mr. Market's panicked offer. The financial advantage is twofold. First, he has an enormous margin of safety, another key Graham concept. Even if his value calculation is a bit off, even if the business is only worth $80, he is still buying at a steep discount, which protects him from permanent capital loss. Second, his potential for upside is massive. When Mr. Market eventually sobers up and reality sets in, the price will inevitably gravitate back towards the $100 value, handing the intelligent investor a 100% return. The Mr. Market allegory is what creates the mental space to perform this analysis and execute this strategy. It allows you to divorce your decision-making from the terrifying, seductive noise of daily price quotes and anchor it to the firm foundation of business value. This separation is everything. It is the single greatest structural advantage an individual investor can have, turning market volatility from a source of risk into the primary source of opportunity. The true test of any mental model is how it performs under extreme pressure. It is easy to be a stoic investor in a calm market. It is another thing entirely when the world feels like it is ending. The date was October 19, 1987, a day that would be forever known as Black Monday. The Dow Jones Industrial Average plunged 508 points, a staggering 22.6% drop in a single trading session. To this day, it is the largest one-day percentage loss in the index's history. The panic was palpable. Computerized trading programs, a relatively new phenomenon, were accelerating the selling, creating a feedback loop of terror. The system was in freefall, and no one knew where the bottom was. Stories circulated of brokers weeping on the floor of the New York Stock Exchange. The media was in a frenzy, with headlines predicting a new Great Depression. The fight-or-flight instinct of the entire financial world had been triggered simultaneously. Now let's travel to Omaha, Nebraska, to the modest offices of Berkshire Hathaway. How did Warren Buffett, the world's most famous disciple of Benjamin Graham, react to this unprecedented chaos? According to those who were there, he was the calmest man in America. He didn't spend the day glued to a screen, wringing his hands. He didn't call his broker in a panic to sell. He went about his day, reading annual reports, talking on the phone, and as he later told reporters, he saw the crash not as a disaster, but as an opportunity that had likely passed him by for the moment. Because the market had fallen so fast it was shut down. He didn't sell a single share of his major holdings like Coca-Cola or the Washington Post. Why? Because the events of Black Monday had absolutely nothing to do with the long-term value of those businesses. Coca-Cola was still going to sell billions of servings of its drinks the next day. The Washington Post was still the dominant newspaper in the nation's capital. The intrinsic value of his companies hadn't changed, but their prices, thanks to a massive panic attack from Mr. Market, had been slashed. In the days and weeks that followed, as others were still paralyzed by fear, Buffett and his team were quietly looking for bargains, buying more of the great businesses he already owned at newly discounted prices. He understood that the crash was not a judgment on the economy, it was a liquidation of weak, over-leveraged speculators. It was a purely psychological event. He had his internal citadel of the self, a fortress of reason built on the foundation of the Mr. Market allegory. While the rest of the world saw a 5-alarm fire, Buffett saw a fire sale. His calm was not a personality trait, it was the result of a rigorously applied mental model. He knew his business partner was having a breakdown, and he simply refused to participate in the madness. Buffett's seemingly superhuman calm on Black Monday was not the result of having ice in his veins. It was the result of understanding the specific cognitive biases that were hijacking the brains of millions of other investors. The primary culprit is a psychological principle known as loss aversion. Pioneered by psychologists Daniel Kahneman and Amos Tversky, loss aversion describes our tendency to feel the pain of a loss approximately twice as strongly as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This is an evolutionary feature, not a bug. For an organism living on the edge of survival, the loss of a food source could be fatal, while the gain of an extra food source is merely beneficial. Our brains are therefore exquisitely tuned to avoid losses. A stock market crash is loss aversion on a massive global scale. When you see your portfolio value drop by 20%, your brain doesn't process this as a temporary fluctuation in the price quotes offered by an irrational partner. It processes it as a direct, painful loss. This triggers the amygdala, the brain's ancient fear center. The amygdala's job is to scan for threats and initiate the fight-or-flight response, flooding your system with cortisol and adrenaline. It effectively hijacks your rational brain, the prefrontal cortex, which is responsible for long-term planning and logical analysis. This is what's known as an amygdala hijack. You are literally not thinking straight. You are in survival mode, and in survival mode the only goal is to make the pain stop. The easiest way to make the pain of a falling portfolio stop is to sell. The moment you sell, the loss is realized, and the uncertainty is gone. You feel a sense of relief, even though you have just committed a financially disastrous act. The Mr. Market allegory is the ultimate tool for preventing this amygdala hijack. By framing the price drop not as a loss but as a, quote, bargain offer from a crazy person, you shift the cognitive frame. It's no longer a threat to be feared, but a piece of information to be evaluated. This keeps the prefrontal cortex online. It allows you to ask rational questions. Has the underlying value of the business changed? Is this offer attractive relative to my assessment of that value? You are moving the decision from the emotional, reactive part of your brain to the logical, analytical part. This is the essence of investor psychology. It's not about being smarter than everyone else. It's about having a better process for managing your own innate and often counterproductive emotional responses. Mastering this internal battle is the prerequisite for any long-term strategy aimed at achieving financial freedom. Knowing the psychology is one thing, operationalizing it is another. To protect yourself from your own primal instincts during a market storm, you need a system created in a time of calm to guide you through the chaos. This is the blueprint for building that system, the pre-mortem and the investment policy statement. This is a written contract you make with your future panicked self. Step 1 is the pre-mortem. This concept, popularized by psychologist Gary Klein, involves imagining that your plan has already failed spectacularly and working backward to figure out why. In our context, you sit down today when the market is calm and you imagine it's 1 year from now. The market has crashed 40% and you have panicked and sold everything at the bottom, locking in massive losses. Now, write down the story of how that happened. What were the specific pressures that made you crack? Was it the scary headlines, Was it a phone call from a terrified family member? Was it the sheer pain of seeing your net worth plummet day after day? Be brutally honest. By identifying your specific psychological weak points in advance, you can begin to build defenses against them. Step 2 is to craft your investment policy statement, or IPS. This is a formal document that will govern your behavior. It has 3 key sections. First, your philosophy. Write down, in your own words, why you are a long-term investor. State your belief that market crashes are temporary psychological events, not permanent impairments of business value. Explicitly write, I will view market volatility as an opportunity, not a threat. I will treat Mr. Market's pessimistic quotes as a potential fire sale. Second, your rules of engagement. This is where you get specific. Create hard and fast rules. For example, if the S&P 500 drops by 20% from its peak, I will not sell any of my core holdings. I will review my pre-made crisis shopping list and begin deploying 25% of my available cash. Create further rules for a 30% drop and a 40% drop. You are creating an automatic, non-negotiable playbook. Your job during the crash is not to think, but to execute the plan your calmer, more rational self already created. Third, your communication blackout. In your IPS, you must specify how you will manage information flow during a crash. For instance, during a market decline of more than 20%, I will limit my consumption of financial news to 15 minutes per day. I will not check my portfolio value more than once per day. I will not discuss my investments with anyone who is panicking. This is critical. You are protecting your rational mind from the emotional contagion of fear. This document, the pre-mortem and the IPS, becomes your anchor. When the storm hits and your amygdala starts screaming, you don't have to rely on willpower. You pull out the document and read the words you wrote. You follow the rules you laid out. You are, in effect, outsourcing your decision-making to the smartest person you know, the calm, rational version of yourself. The path of the 99% during a crash is a tragic and predictable story, a psychological cascade that almost guarantees the destruction of wealth. It begins not with a decision, but with a feeling. The market starts to fall, and the investor feels a knot of anxiety in their stomach. Their first instinct is to seek information, but they don't seek out balanced, long-term perspectives. They turn on the financial news, which by its very nature is designed to sensationalize fear for ratings. They see chyrons flashing, market in turmoil, and listen to experts with grim faces talk about contagion and systemic risk. This confirms and amplifies their initial anxiety. Next comes the flawed social proof. They check social media and see a torrent of fear. They talk to their friends, their family, their colleagues, who are all asking the same worried question, are you selling? The herd is moving, and the instinct to move with it for safety is overwhelming. At this point, the amygdala hijack is in full swing. The pain of loss aversion is becoming unbearable. Every time they check their phone, which is now every 5 minutes, the sea of red reinforces the feeling of loss and mistake. Their portfolio is no longer a collection of ownership stakes in productive businesses. It has become a source of continuous, agonizing psychological punishment. Finally, they reach the breaking point. They can't take the pain anymore. They sell. They hit the button, and in that moment, a wave of relief washes over them. The pain has stopped. They tell themselves they have been prudent, that they have gone to cash to protect what's left. They promise they will get back into the market when things calm down, or when there's more certainty. But of course, the point of maximum certainty is long after the market has bottomed and has already recovered significantly. They end up sitting in cash while the market rips higher, paralyzed by the fear of buying back in at the wrong time. Eventually, as the bull market rages and FOMO replaces the fear of loss, they buy back in, often at prices higher than where they originally sold. This is the panic seller's cascade, a predictable sequence of emotional contagion, loss aversion, and flawed reasoning that leads investors to systematically buy high and sell low, turning the powerful engine of compounding into a machine for wealth destruction. They are not just losing money, they are paying a hidden exorbitant tax for their inability to manage their own emotions. The financial cost of succumbing to this panic is not trivial. It is a quantifiable drag on performance so significant that it can be the difference between a comfortable retirement and a future of financial struggle. We can call this the volatility tax. It is the wealth you surrender not because of bad investment choices, but because of bad emotional timing. Let's run the numbers. Imagine two investors, Investor A and Investor B. Both start with a $100,000 portfolio. A market crash occurs, and the value of their portfolios drops by 30% to $70,000. Investor A, our intelligent investor armed with the Mr. Market model, does nothing. She understands that the value of her businesses has not dropped by 30%, only the price quotes from her manic partner. She holds on. Investor B, our panic seller, cannot stand the pain. He sells his entire portfolio at $70,000, telling himself he has protected his remaining capital. Now the market finds its footing and begins to recover. It rallies 30% from the bottom. Investor A's portfolio, which was at $70,000, also rises by 30%. 30% of $70,000 is $21,000. Her portfolio is now worth $91,000. She is still down from the start, but she has captured the full force of the recovery. Investor B, sitting in cash, sees the market rallying and decides it's safe to get back in. He reinvests his $70,000. But because he is buying back an asterisk after times the 30% rally, he has missed that entire rebound. His portfolio is still worth only $70,000. He is now $21,000 poorer than Investor A, forever. That $21,000 gap is the volatility tax. It is a permanent loss of capital that can never be recovered. The compounding potential of that lost money is gone forever. This is the direct financial consequence of listening to Mr. Market's panicked whispers instead of your own rational plan. The citadel of the self isn't just a psychological comfort blanket. It is a high-performance financial engine. The ability to remain invested during a downturn, or better yet, to add new capital, is the single most powerful determinant of long-term investment returns. By avoiding the volatility tax, you give your portfolio the unbroken runway it needs for the magic of compounding to do its work, transforming market chaos from a liability into the very fuel for your journey to financial freedom. If mastering fear is the defensive posture in the Mr. Market philosophy, learning to channel greed, or as Buffett would call it, opportunistic aggression, is the offense. It is the active strategy of going on a shopping spree when everyone else is hiding in the shelter. There is no greater example of this in modern history than Buffett's actions during the 2008 global financial crisis. The autumn of 2008 was not just a market crash, it was a heart attack for the entire global financial system. Lehman Brothers, a 158-year-old institution, had collapsed into bankruptcy. AIG, the world's largest insurer, had been bailed out by the government. The credit markets were frozen solid. There was a genuine, terrifying possibility that the world's ATMs could stop dispensing cash. Fear was not just in the stock market, it was in the streets. Mr. Market was not just depressive, he was catatonic with terror. And in the midst of this chaos, the phone rang in Omaha. On one end was the CEO of Goldman Sachs, one of the most prestigious investment banks in the world. Goldman was not failing, but its stock was being hammered by fear, and it needed a vote of confidence, a capital injection from the most trusted name in finance. They needed Warren Buffett. Buffett didn't just agree to invest, he dictated the terms. He invested $5 billion in Goldman Sachs, but not by buying common stock on the open market. He bought preferred stock that paid him a guaranteed 10% dividend, $500 million a year, no matter what the stock price did. And for good measure, he received warrants that gave him the right to buy another $5 billion worth of common stock at a fixed price any time in the next 5 years. It was an incredibly lucrative deal, possible only because Goldman was desperate and Buffett was one of the few people on earth with both the capital and the courage to act. Days later, he did it again, striking a similar $3 billion deal with General Electric, another titan of American industry that was being pummeled by fear. While the world was selling, Buffett was investing $8 billion in the span of a few weeks. In October 2008, he published an op-ed in the New York Times titled, "Buy American, I Am." He laid out his philosophy for the entire world to see, writing the now famous line, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful." This was not just a clever aphorism. It was a declaration of his offensive strategy. He was using the terror of Mr. Market as the ultimate negotiating tool, securing terms for Berkshire Hathaway that were simply unthinkable in a normal market. He was not catching a falling knife. He was being handed the keys to the kingdom for a fraction of their worth, precisely because he was the only one willing to walk through the door while the castle was supposedly on fire. Buffett's ability to charge into the fire of the 2008 crisis is a masterclass in overcoming another powerful cognitive bias, herd bias. Humans are social creatures. For millennia, our survival depended on our ability to stick with the tribe. The individual who wandered off alone was far more likely to be eaten by a predator. This deep-seated instinct manifests in modern life as a powerful need for social proof. We feel safer and more confident in our decisions when we see many other people making the same choice. This is why we look at restaurant reviews, why fashion trends exist, and why we feel an anxious pull to do what the crowd is doing. In financial markets, this instinct is deadly. When the herd is selling, every fiber of your being screams at you to sell too. To stand apart and buy when everyone else is selling feels profoundly unsafe. It feels wrong, arrogant, and dangerous. You are going against the collective wisdom of millions of people. This psychological pressure is immense. Contrarian investing, the practice of going against the market consensus, is often misunderstood as simply doing the opposite of the crowd for the sake of it. But true, intelligent contrarianism isn't about being a rebel. It's about achieving a state of disciplined independence of thought. The Mr. Market allegory is the mechanism for achieving this independence. It reframes the situation. You are not bravely standing against a crowd of millions of rational actors. You are simply declining an offer from one single, hysterical business partner. The herd is just Mr. Market and all the people who have been infected by his panic. By seeing the market action through this lens, you depersonalize the pressure. You are no longer in a battle of you versus the world. You are in a simple business negotiation between you and your partner. Can you get a good price? Is the offer attractive based on your independent analysis of the business's value? This reframing allows you to detach from the emotional currents of the herd and anchor yourself to the logic of your own research. You are able to be greedy not because you are a reckless gambler, but because your mental model allows you to see the herd's fear not as a valid warning signal, but as the very source of the opportunity itself. You are not smarter than the herd, but you are using a better mental framework that insulates you from their contagious and ultimately wealth-destroying emotions. To effectively go on the offensive during a market panic, you cannot be fumbling around trying to decide what to buy. The time for analysis is before the crisis, not during it. The blueprint for this offensive strategy is the creation of a crisis shopping list. This is a tangible document you build during times of market calm that becomes your executable battle plan when the panic sets in. Step 1 is to identify your dream companies. These are the castles of the business world. Companies with what Buffett calls durable competitive advantages or moats. Think of iconic brands, companies with network effects, or low-cost producers. These are businesses you would be thrilled to own a piece of for the next 20 years, but which, in a normal market, are often too expensive. Make a list of 10 to 15 such companies. Step 2 is to do the deep work of valuation. For each company on your list, you must build a case for its intrinsic value. This involves reading their annual reports, understanding their business model, and making a conservative estimate of their future earnings power. The goal is to arrive at a rough, per-share value that represents what the business is actually worth, completely independent of its current stock price. For example, you might conclude that company X is fundamentally worth $150 per share. Step 3 is to set your target buy prices. This is where you incorporate Ben Graham's margin of safety. You will not buy at your estimate of intrinsic value. You will only buy at a significant discount to it. You might set a Tier 1 buy price at a 30% discount. For company X, that would be $105. You might set a Tier 2 buy price at a 50% discount, $75. A price that you would only expect to see in a full-blown market panic. Step 4 is to determine your capital allocation in advance. Decide how much cash you will keep on the sidelines specifically for this purpose, and how you will deploy it. For example, I will deploy 1/3 of my crisis cash when the S&P 500 is down 25%, targeting companies on my list that are near their Tier 1 prices. I will deploy another third if the market falls 40%, targeting Tier 2 prices. This complete document, the list of companies, the valuation work, the tiered buy prices, and the allocation strategy, is your crisis shopping list. When the market does crash, your task is simplified. You are not reacting to fear or trying to analyze companies in a maelstrom of negative news. You are an assassin, calmly executing a predetermined plan. You check your list, you see that Mr. Market is now offering you company X for $75 in his panic, and you execute your buy order. This transforms you from a victim of the crash into its beneficiary. The single greatest fear that paralyzes investors and prevents them from buying during a crash is the fear of catching a falling knife. This is the worry that if you buy a stock after it has fallen 30%, it will just continue to fall another 30%, making you look like a fool. The desire is to wait for confirmation that the bottom is in, to wait until the knife has hit the floor and stopped quivering before picking it up. This is the path of the 99%, and it is a subtle but devastating mistake. The problem is that the bottom is only ever visible in the rearview mirror. The exact moment of maximum pessimism, the point where the selling is exhausted and the market turns, is never announced by a bell. In fact, the news flow at the absolute bottom is often the most terrifying. By waiting for certainty, by waiting for the fear to subside and the headlines to turn positive, an investor guarantees they will miss the period of greatest opportunity. The rebound from a market bottom is often ferocious and happens long before the economic all clear has sounded. Those who wait for confirmation are effectively deciding to pay higher prices. They are letting Mr. Market's mood dictate their entry point, and they are choosing to enter only after he has started to recover from his depression and is raising his prices accordingly. The intelligent investor understands that the goal is not to time the bottom perfectly. This is an impossible task. The goal is to buy wonderful businesses at a significant discount to their intrinsic value. If you can buy a $100 business for $50, you have already secured a massive advantage. Whether it temporarily goes to $40 before recovering to $100 is irrelevant noise. Your margin of safety protects you. The focus on catching a falling knife is a symptom of a mind that is still fixated on price action rather than business value. It is the lingering fear that the market knows something you don't. But the disciple of the Mr. Market allegory knows better. The market, in a panic, knows nothing. It is merely feeling. By focusing on the yawning gap between the low price being offered and the high value of the asset being sold, the investor can act with confidence, knowing that a great purchase price is the ultimate antidote to the fear of further declines. The direct financial connection of this offensive strategy is the active cultivation of Ben Graham's central investment concept, the margin of safety. The margin of safety is the buffer between the price you pay for an asset and its underlying intrinsic value. A market crash is nothing more than Mr. Market offering you the widest possible margin of safety. It is a system-wide discount event. Let's quantify the power of this. Suppose in a normal market, a good company is trading at $80 a share, and you've calculated its intrinsic value to be $100. You have a $20 or or 20% margin of safety. This is good but not extraordinary. Now, a market crash occurs, and Mr. Market, in his panic, offers you that same $100 business for just $40 a share. Your margin of safety has just exploded to $60 or 60%. This massive buffer has two profound financial effects. First, it provides powerful downside protection. For you to lose money permanently on this investment, the business would have to suffer a catastrophic decline, losing more than 60% of its intrinsic value. The chances of this happening to a truly great company are very low. Your purchase price acts as a giant shock absorber against unforeseen negative events. You have dramatically reduced your risk. Second, it creates explosive upside potential. From a price of $40, a simple return to its fair value of $100 represents a 150% gain on your investment. Had you bought at $80, the same return to fair value would only yield a 25% gain. By acting when the margin of safety was at its widest, you have amplified your potential returns by a factor of 6. Buffett's 2008 Goldman Sachs deal was a margin of safety masterpiece. He wasn't just buying stock, he was getting a guaranteed 10% dividend, which meant he was getting paid handsomely while he waited for the price to recover. The warrants he received were a free call option on the massive upside. He had insulated his downside while securing an almost unlimited upside. This is the financial endgame of being greedy when others are fearful. You use the market's irrationality to demand and receive a price so far below intrinsic value that you dramatically lower your risk while simultaneously maximizing your potential reward. It is the closest thing to a heads I win, tails I don't lose much scenario that exists in the world of finance. There is a flip side to the Mr. Market allegory, a defensive wisdom that is just as crucial as the offensive opportunism. It is the virtue of knowing when to do nothing. It is the discipline to stand still when your manic partner, Mr. Market, is in a state of wild, irrational euphoria. The greatest test of this discipline in Warren Buffett's career was the dot-com bubble of the late 1990s. It was a time of irrational exuberance, as Fed Chairman Alan Greenspan called it. A new paradigm, the Internet, was changing the world, and any company with a .com after its name was soaring to astronomical valuations, often without any profits or even a coherent business plan. The Nasdaq index, full of these new tech darlings, more than doubled in a single year. It was a nationwide frenzy. Everyone, from janitors to dentists, was a day trader, bragging about their tech stock winnings at cocktail parties. And in the midst of this euphoria, Warren Buffett became a pariah. Berkshire Hathaway's stock, filled with old economy businesses like insurance and candy, was dramatically underperforming the market. Buffett was openly mocked on the covers of major financial magazines. He was called a dinosaur, a relic from a bygone era who just didn't get it. The pressure on him to abandon his value principles and join the party must have been immense. His own shareholders were questioning him. The entire world was telling him he was wrong, but Buffett stood his ground. He calmly admitted that he didn't understand the valuations of these new tech companies. He couldn't project their cash flows with any certainty, and therefore they were outside his, quote, circle of competence. He refused to play a game where he didn't understand the rules. In his 1999 letter to shareholders, at the very peak of the mania, he patiently explained his reasoning, quoting Kipling, "If you can keep your head when all about you are losing theirs." He was watching Mr. Market in his most manic state, offering to sell him assets at prices that made no logical sense, and he was politely declining, day after day. Then, in March of 2000, the bubble burst. The Nasdaq collapsed, losing nearly 80% of its value over the next 2 years. Fortunes were vaporized overnight. The same magazines that had mocked Buffett were now running stories about the carnage. And Buffett, who had preserved his capital by refusing to participate in the mania, now had a mountain of cash ready to deploy into a market where prices had finally returned to sane levels. His discipline of inaction during the boom was the very thing that enabled his aggressive action during the bust. He proved that sometimes the most profitable move an investor can make is to sit still. The dot-com bubble was a mass psychological event powered by two of the most potent cognitive biases that affect investors in a bull market: FOMO, the fear of missing out, and overconfidence bias. FOMO is the social cousin of herd behavior. It's the intensely anxious feeling you get when you see others experiencing success or rewards that you are not. During the late 90s, people were watching their neighbors, who seemingly knew nothing about investing, get rich buying stocks like pets.com. This creates a powerful, almost unbearable psychological pressure to join in. To sit on the sidelines feels like you are actively choosing to be left behind. It's a direct assault on our relative social standing. Mr. Market is at your door every day, not whispering about doom but shouting about glorious, easy profits that everyone else is enjoying. Resisting this siren song is incredibly difficult. Compounding this is the overconfidence bias. In a raging bull market, it's easy to mistake luck for skill. An investor might make a few speculative bets that pay off handsomely. Their brain, seeking to create a narrative of competence, attributes this success to their own genius rather than the fact that a rising tide was lifting all boats, even the leaky ones. This initial success breeds overconfidence, leading them to take bigger and bigger risks. They believe they have cracked the code and are no longer subject to the old rules of valuation. They are the new masters of the universe. The Mr. Market allegory provides a powerful antidote to both biases. When confronted with FOMO, the intelligent investor asks, "Is this my manic partner offering me a sensible price, or is he just caught up in a speculative frenzy?" It reframes the missed opportunity as avoiding a foolish deal. It turns inaction from a passive failure into an active, disciplined choice. Against overconfidence, the allegory provides a dose of humility. By externalizing the market's mood, it reminds the investor that rising prices are often a reflection of Mr. Market's mania, not their own brilliance. It encourages a healthy skepticism, prompting the question, "Am I a genius or is my business partner just in a very good mood today?" This keeps the investor grounded in the reality of business value, rather than floating away on the intoxicating fumes of a speculative bubble. The practical tool for resisting the siren song of a euphoric Mr. Market is not just willpower, it's a rigorously defined intellectual boundary. This is the blueprint for its construction, the circle of competence audit. This concept, central to the thinking of both Buffett and his partner Charlie Munger, is the idea that every investor has a limited area of expertise. Your goal is not to be an expert on everything, but to know the perimeter of your own knowledge intimately, and to never, ever stray outside of it. Step 1 is to define your circle. Take out a piece of paper and draw a large circle. Inside this circle, you must write down the industries, business models, and technologies that you understand deeply. This requires profound intellectual honesty. Don't write down technology, that's too broad. Write down enterprise software as a service billing models or the economics of franchise fast food restaurants. Be specific. Your circle might be based on your profession, a lifelong hobby, or an area you have studied intensely. It is perfectly fine if your circle is small. What matters is not the size of the circle, but your clarity about its boundaries. Step 2 is to create the too hard pile. This is everything that falls outside your circle. For Buffett, during the dot-com boom, high-flying tech companies went straight into his too hard pile. He didn't say they were bad investments. He simply said he did not have the expertise to value them confidently. This is not an admission of failure. It is an act of intellectual discipline. You must be comfortable saying, "I don't know," and moving on. Step 3 is to make it an ironclad rule. Your circle of competence becomes your ultimate investment filter. When a new, exciting investment idea comes along, perhaps pitched by a euphoric Mr. Market, your very first question is not, "Can I make money on this?" but, "Is this inside my circle?" If the answer is no, the process stops right there. There is no further analysis. The idea is discarded. This is not a suggestion, it is a rigid, non-negotiable rule. The circle of competence audit is your primary defense against FOMO. It provides a logical, pre-committed reason to say no. You are not missing out. You are prudently sticking to your area of expertise. It is the seatbelt that keeps you strapped in when your manic partner, Mr. Market, is trying to convince you to take his flying saucer for a joyride to the moon. It ensures that when you do invest, you are operating from a position of deep knowledge, giving you the conviction to hold on, even if Mr. Market's mood eventually sours. The path of the 99% during a bubble is the path of the speculator, not the investor. They become participants in a dangerous game governed by what's known as the greater fool theory. The speculator who buys an asset at a clearly inflated price isn't necessarily irrational. Their rationale is that the asset's price will continue to go up, and they will be able to sell it to an even greater fool at an even higher price before the bubble bursts. It becomes a nationwide game of musical chairs. As long as the music is playing, everyone is dancing and having a wonderful time. The problem, of course, is that eventually the music stops. Suddenly, there are no more greater fools to be found. The last person holding the asset is left with something that is worth a fraction of what they paid for it. The participants in the dot-com bubble were, for the most part, not investing in the long-term cash flows of businesses. They were making a bet on crowd psychology. They were betting that Mr. Market's mania would continue long enough for them to get in, make a quick profit, and get out before his mood turned. This is a fundamentally different activity from what Warren Buffett does. Investing is about determining the intrinsic value of a business and buying it for less than that value. Speculation is about predicting the price movements of a piece of paper, regardless of its underlying value. It is an attempt to read Mr. Market's mind, to outsmart the manic depressive. The speculator is deeply, intimately engaged with Mr. Market's every whim. They watch his every twitch, trying to anticipate his next move. The investor, by contrast, largely ignores him, waiting only for the rare moments when his emotional state creates a truly compelling opportunity. The greater fool theory always ends in tears, because bubbles are not sustainable. They are built on a foundation of emotion and borrowed money, not economic reality. To participate in a bubble is to consciously choose to become a slave to Mr. Market's mood, hoping you can get off the ride before it crashes. The intelligent investor knows that the only winning move in this particular game is not to play. The direct financial connection of this defensive discipline is one of the most powerful and underrated forces in wealth building, the preservation of capital. It is encapsulated in Buffett's two famous rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This is not about avoiding any and all temporary price declines. It is about avoiding the kind of catastrophic, permanent loss of capital that comes from being caught in a speculative bubble that bursts. The mathematics of loss are brutally asymmetric. If you lose 50% of your capital, you don't need to make a 50% gain to get back to even. You need to make a 100% gain just to get back to where you started. A $500,000 portfolio that falls to $250,000 requires a full doubling in value to return to $500,000. That kind of devastating setback can destroy years or even decades of patient compounding. By sitting out the dot-com bubble, Buffett's primary achievement was not that he missed the crash, but that he preserved his capital. When the Nasdaq fell 80%, Berkshire Hathaway's capital base remained intact. This meant he had the financial firepower, the dry powder, to take advantage of the fear and devastation that followed. His decision to sit still didn't just save him from losses, it armed him for future gains. On a balance sheet, this principle is reflected in a strong cash position during times of market euphoria. While others are fully invested and leveraged to the hilt, the prudent investor is trimming positions that have become overvalued and allowing cash to build up. This cash is not idle. It is a strategic asset. It is a call option on a future market crash, giving its owner the right, but not the obligation, to buy assets at bargain prices when Mr. Market has his inevitable breakdown. The financial power of sitting still, therefore, is not just about the losses you avoid, it is about the opportunities you are creating for yourself in the future. It is the ultimate act of strategic patience, a recognition that in the long game of wealth building, a strong defense is the foundation of a truly explosive offense. The final pillar of this philosophy is the grand symbiosis, the integration of the Mr. Market mental model into a complete, holistic approach to long-term wealth creation. It's about understanding that Mr. Market is merely the gatekeeper. He can offer you a wonderful entry price, but the real, multi-generational wealth is built by what you choose to buy and how long you hold it. The perfect anecdote to illustrate this is not a dramatic crisis investment, but a quiet, foundational purchase made in 1972, See's Candies. At the time, Buffett and Munger were looking to buy great businesses outright for Berkshire Hathaway. They were introduced to See's, a beloved West Coast boxed chocolate company. The company was a gem. It had a fanatically loyal customer base, a powerful brand that commanded pricing power, and a simple, understandable business model. The problem was the price. The See's family wanted $30 million for the business. Buffett, still a strict disciple of Ben Graham's cigar butt investing, calculated its tangible assets, its book value, at only about $8 million. Paying $30 million meant paying a huge premium for intangible assets like the brand name. Graham would have been horrified. Buffett initially walked away from the deal. But his partner, Charlie Munger, pushed him. Munger argued that they needed to evolve their thinking. A truly wonderful business with a durable competitive advantage was worth paying a premium for. A fair business at a wonderful price was good, but a wonderful business at a fair price was even better, Buffett was convinced. They negotiated the price down to $25 million and bought the company. This decision marked a crucial evolution in his thinking. It was the fusion of Graham's price consciousness with Philip Fisher's quality consciousness. Mr. Market, in this case the sellers of the private business, was offering them an entry point. But the real insight was recognizing the quality of the asset they were buying. See's Candies became the prototype for the Berkshire Hathaway business model. It required very little new capital to grow, and it gushed cash year after year. That initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire, cash that Buffett then used to buy other stocks and businesses. The lesson is profound. Using Mr. Market's moods to get a good price is the start of the journey. The ultimate goal is to use that good price to become the long-term owner of a superior business, a compounding machine that will build your wealth for decades to come. This long-term symbiotic partnership with great businesses requires a final psychological shift, a mastery of two key principles: delayed gratification and the positive application of the endowment effect. Delayed gratification is the ability to resist the temptation of an immediate reward in order to receive a more substantial reward later. In investing, the temptation is to sell a stock after it has had a nice run-up, to lock in that quick profit. It feels good, it provides immediate validation, but the true titans of wealth creation, like Buffett, understand that the real money is made by holding on to a wonderful, growing business for 10, 20, or even 50 years, allowing the miracle of compounding to work its magic. Selling a company like See's Candies after it had doubled would have been a catastrophic mistake. The Mr. Market allegory helps here. When Mr. Market offers you a handsome profit on a stock you own, you can frame it as, "My partner is in a good mood today, but why would I sell my share of this incredible compounding machine just because he's feeling optimistic?" This ties into the endowment effect, our tendency to value something more highly simply because we own it. This is often a bias to be overcome, but it can be harnessed for good. When you shift your mindset from being a stock renter to a business owner, you begin to feel a sense of pride and partnership with the company. You are no longer just holding a ticker symbol. You are a part owner of a real enterprise with employees, customers, and a future. This psychological endowment makes you far less likely to sell your stake based on the manic depressive whims of your business partner, Mr. Market. You are in it for the long haul. This mastery of delayed gratification, fueled by an owner's mindset, is the final psychological barrier between being a decent investor and becoming a true compounding machine. It is the ability to not only buy right, but to sit right. The final blueprint, the ultimate mental model to install, is the business owner's mindset shift. This is a series of active exercises designed to completely rewire your relationship with your investments, moving you from a speculator of prices to an owner of businesses. Step 1 is to cure your addiction to the ticker. For the next 30 days, commit to not checking the stock prices of your holdings more than once a week. This will be difficult at first. The flashing green and red numbers are designed to be addictive, but you must break the cycle. The daily quotes are just the manic chatter of Mr. Market. They have almost nothing to do with the underlying value of your businesses. Step 2 is to replace that habit with a new one: reading. Pick one company in your portfolio. Your mission is to read its most recent annual report from cover to cover, especially the letter to shareholders from the CEO. Then, read the annual reports from the last 2 years as well. Your goal is to be able to answer, without looking it up, who is the CEO? What is the company's primary competitive advantage? Who are its main competitors? How does it make money? This exercise forces you to engage with the business, not just its stock chart. Step 3 is to become a customer. If you own stock in a consumer-facing company, go out and use their products or services. If you own Starbucks, go to a store and observe the customer traffic, the morale of the employees, the quality of the coffee. If you own Apple, go to an Apple store and feel the energy, the brand loyalty. This grounds your investment in the real world. You are connecting with the tangible reality of the business you partly own. By consistently practicing these 3 steps, curing the ticker addiction, reading the reports, and engaging with the business, you will fundamentally change your perspective. Stocks will cease to be abstract blips on a screen and will become what they truly are: fractional ownership stakes in living, breathing enterprises. Your relationship with Mr. Market will be forever changed. He is no longer the source of truth. He is just the guy who runs the stock exchange, a necessary but ultimately peripheral character in your long-term journey as a business owner. This is the final integration, the point where you are no longer just using a mental model, but have fully embodied the philosophy of the intelligent investor. The antithesis to this patient, business-focused approach is the path taken by the vast majority of market participants, the speculator's game. This is the world of day trading, of complex option strategies, of chasing the latest hot cryptocurrency, of obsessing over technical analysis and chart patterns. The speculator is not interested in the intrinsic value of a business. Their entire focus is on predicting the short-term price movements, predicting the mood swings of Mr. Market. They believe they can outsmart him, that they can discern a pattern in his madness. This is an incredibly seductive but ultimately arrogant and losing proposition. It is a zero-sum game at best and a negative-sum game after accounting for trading costs and taxes. For every speculator who correctly guesses a short-term move, another speculator on the other side of the trade must be wrong. You are pitting your wits, your emotions, and your algorithms against millions of other speculators, high-frequency trading firms, and the sheer unpredictable randomness of crowd psychology. It is a world of immense stress, constant screen watching, and the ever-present risk of blowing up your account on a single bad bet. The speculator lives and dies by Mr. Market's every word. They are completely enmeshed in his psychological drama, trying to surf the waves of his mania and avoid the undertow of his depression. It is the exact opposite of the detached, serene, and ultimately far more profitable approach of the intelligent investor. The speculator tries to beat Mr. Market at his own game. The investor understands that the only way to win is to refuse to play his game at all, and instead to play a different game entirely, the game of buying wonderful businesses at sensible prices and holding them for a very, very long time. The ultimate financial prize for integrating all these pillars is not just a successful trade or a good year, it is the creation of a true compounding machine. This is the grand financial connection, the end game of the entire Mr. Market philosophy. When you combine the emotional discipline to buy during panics with the analytical discipline to buy only high-quality businesses with durable competitive advantages, you are not just making an investment, you are acquiring an asset that will work for you for the rest of your life. Let's return to the See's Candies example. The $25 million purchase price, secured because Buffett and Munger had an owner's mindset, was the entry ticket. The compounding machine was the business itself. Because See's had such a strong brand, it could raise the price of its chocolates every year without losing customers. This created ever-increasing profits. And because the business didn't require massive factories or research labs to grow, almost all of that profit was free cash flow that could be sent back to Berkshire Hathaway's headquarters. This stream of cash, over $2 billion and counting from a $25 million investment, is the lifeblood of Berkshire. It's the fuel that Buffett used to buy shares of Coca-Cola, American Express, and Apple when Mr. Market was offering them at bargain prices. The See's Candies purchase, guided by this integrated philosophy, became a critical component of a self-sustaining ecosystem of wealth creation. This is the ultimate goal. You use market downturns to acquire pieces of wonderful businesses. These businesses then generate cash for you. You then use that cash during the next downturn to acquire pieces of other wonderful businesses. This virtuous cycle, repeated over a lifetime, is what builds dynastic, multi-generational wealth. It transforms your portfolio from a collection of stocks into a powerful, automated engine that turns market volatility into ever-increasing ownership of the world's best companies. This is the path to true, unshakable financial freedom. It begins with a simple story about a manic-depressive business partner, and it ends with the construction of an unassailable financial fortress. You have just spent this time acquiring something incredibly valuable. It is not a stock tip or a secret formula. It is a mental tool, a powerful lens through which to view the world of finance. You now possess the master key that Warren Buffett has used to unlock billions of dollars in wealth. The mental model of Mr. Market. You have learned how to personify the market's chaos, to build a citadel of the self against fear, to go on the offensive when others are panicked, and to stand still with virtuous patience when others are greedy. This is more than just theory. It is a complete psychological operating system for turning volatility from your greatest enemy into your most powerful ally. But a key, no matter how powerful, is useless without the map of the territory it unlocks. This emotional shield you've built, this mastery over Mr. Market, is one crucial part of a larger, interconnected system of wealth building. It answers the question of crucial part of a little you've built to act, but it is inextricably linked to the question of crucial part of a little, crucial part of buy. The video on your screen right now is the next piece of that map. It is the link that connects the emotional control you have just mastered to the unshakable logic of identifying the truly great businesses, the compounding machines, that are worth buying when Mr. Market offers you the chance. Most people will stop here, content with one tool, believing they have the whole picture, but you are not most people. Your journey so far proves you are seeking a deeper level of mastery. The decision to click is not just a decision to watch another video. It is a decision to continue your ascent from amateur spectator to a master of the game. It is the choice to build upon your foundation and complete your mental arsenal. The next piece of the map awaits. Click and continue the journey.